Hello and welcome to our monetary policy curtain raiser. It is baptism by fire for the new Reserve Bank governor as he goes ahead to present his maiden monetary policy. The budget was kind, yes, in terms of a lower deficit, but President Trump has created a perfect storm in the global currency markets, including for India. So exactly what should the Reserve Bank and the MPC do? Can you cut when there is a global storm in terms of EM currencies? That's the question for which we need answer. And as always, the Citizens Monetary Policy Committee of CNBC-TV18 meets on the eve of the RBI-MPC to deliberate on what should be the issues and how to look at them. I have with me Chairman of our committee, Dr. Pronab Sen, and members Soumyo Ghosh of State Bank of India, Sajjid Chinoy of JP Morgan, Samiran Chakraborty of Citi India, and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much indeed for your time. It's a very, very crucial policy, as I said. Sajjid, it is the global churn that is going to worry us most. Just outline the, the announcements that have come from the US. What does it do to global inflation and our own inflation expectations? And what does it do to global growth?
Thank you, Lata. I think the global economy is getting more precarious by the day. 2024 was characterized by US exceptionalism, where US growth was very resilient, and that meant a stronger dollar and higher US rates. And both of those things put pressure on emerging market currencies, constraining their space and their ability to respond. What we're seeing now is the onset of the much feared trade war. The US has put on tariffs on Canada, Mexico, China. Those countries have begun to retaliate. So this trade war could get ugly very quickly. And the question really is, number one, this is going to depress global growth. I think the lesson from the first trade war in 2018 was very clear. It was the uncertainty of the trade war that depressed global business sentiment and global capex intentions. And it was very clear in the data in 2018 and 2019. So I think we should brace for a global environment with more growth headwinds, where exports will most likely, take a hit. The difficult question is whether the trade war is going to exacerbate or undermine US exceptionalism, because there is a scenario in which global growth gets hit, but US growth gets hit less because that country has offsets, easier fiscal policy and more deregulation. Now, that's the worst of all worlds for emerging markets, because you are living with lower global growth and therefore lower export growth. But your ability to respond to lower growth is compromised by the fact that US exceptionalism means the dollar remains elevated. Today's dollar rate is almost at 20-year highs, and US rates remain elevated. And then you're in this bind where you want to respond to a more hostile global environment in terms of weaker growth, but you're unable to do so completely.
Yeah, I take your point.
That's the dilemma that these economies face.
Yeah, I take your point entirely, which brings you to the classical question, which the MPC will have to address, Samiran. Can you really respond with rate cuts and growth stimuli in a situation of, tension on the currency?
3 points here. The first point is that when there is so much of global growth uncertainty, we have to think of what we can do for our domestic growth. And from that perspective, whatever the budget is trying to do or whatever the MPC is trying to do will be very much focused on trying to get the domestic growth up. The second point is that to start with, our currency was somewhat overvalued by standard metrics of 40-country trade-weighted RER, etc. So part of the depreciation that we are seeing might actually be a good thing, and to some extent might be also giving that little bit stimulus that exchange rate depreciation gives to the overall growth outlook. So some part of the depreciation might not actually be a bad thing at all. And the third issue is that there is, at least our view is that our capital flows are more growth sensitive than interest rate sensitive. So it is somewhat unorthodox view, but if the governor, RBI, MPC, they believe that they can spur growth expectations at this juncture by a somewhat easier monetary policy in tandem with the fiscal consumption stimulus that we have seen, then it might just kickstart the capital flows into India, which are more growth sensitive, and to some extent that can stabilize the currency as well. So to me, the interest rate cut is not necessarily an antithesis to the currency story.
No, actually, you're right. Even in the last few days, we have seen inflation, we are seeing actually debt flows continuing somewhat. It's only equity that's hurt. If interest rate differential was such an issue, we should not be seeing debt flows. But, your growth issue is more important. Is growth really under so much threat? Dr. Sen, that question to you actually. The budget is expected to have boosted consumption since it has cut taxes so generously. So what's your assessment of growth per se, domestically speaking? Do you think growth has a better chance now in FY26?
That's not clear, Lata, because they've given with one hand and taken away with another. And the way it's been done, I find a little disturbing, particularly for the consumption story.
Yes.
Because what they've done, in effect, is given a break to the middle class.
Yes.
But they have reduced the outlay on education, health, social services of various kinds, which essentially affect the lifestyle of the poorer, which is much the larger number. And we do not know whether these people will be then forced to, in a sense, rejig their consumption basket. And the net effect may well turn out to be negative.
Okay, well, yeah, that there is, of course, not much for the bottom of the pyramid, if you look at it that way. But let me also get, some inflation questions out of the way. Sonal, how would you look at inflation now? Is there a possibility that with so much of, uncertainty and supply chain disruptions likely, inflation may surprise negative? Or is inflation definitely headed towards 4.2 or something, which the Reserve Bank is forecasting?
For now, Lata, it looks like we are headed in the 4.5% range. I mean, if you look at India's CPI basket, bulk of it is actually non-tradable. So food services play a much bigger role. The pass-through from currency weakness, our estimate is a 5% depreciation leads to about a 30 basis point impact on headline inflation. And we are in a soft demand environment. So really the spillover to consumers will be less. There's a bigger risk that firms see pressure on their corporate profit margins. Food in particular, we've seen a positive surprise. The two items that were holding inflation up, which is vegetables and pulses, are sequentially falling. And the big run-up in edible oil prices, the pace of increase there is also slowing down. So we are seeing some positive news on food inflation. Rabi prospects look a bit uncertain, but on the whole, I would say the decline in headline inflation and core, which is very well anchored, soft demand conditions mean that headline inflation, which was at 5.2% in December, should come down to below 4.5%, in fact, in January itself, and then stay in this 4.5% range through the next 12 months. So the inflation outlook does look a lot more favorable.
Okay, so that means the Reserve Bank has more elbow room. Well, let me get a little more on growth, and then I come to the all-important steps, the liquidity steps in particular. Soumyo, if you can wrap up the growth argument, how will a lower currency at 87.30 or 87.50 help growth? Again, there is the budget. Are we in a position to expect better growth in FY26 than in 25?
Yeah, thank you, Lata. I think regarding before I answer the question on growth, the point on exchange rate you mentioned, I think exchange rate movements in India, as we see that the exchange rate there has been again a significant depression in the value of the exchange rate because of the measures of President Trump. But my sense is that also a large part of the currency movement is also growth accretive in the Indian context. If you actually do an empirical analysis, you will find that apart from the dollar index movement, which determines the direction of the value of the rupee, a large part of the rupee is also determined by the factors which are positive to growth. So from that point of view, I think these current movements in exchange rate, we should understand the global idiosyncrasies. And the best thing to happen at this point of time is basically look into the growth prospects. As of now, if you ask me about the growth prospects for the next fiscal year, the numbers are actually not significantly different from what you will get in the current fiscal year, which is basically FY26. So my sense is that I think it will be better if we look into the perspective from a growth one rather than purely from an exchange rate perspective that what one may think of.
Okay. So short point, you're saying that next year's growth will be as good as this year's or as bad as. So something like 6.3, 6.4.
Yeah, it should be similar to this year's growth rate. So from that point of view, I think there could be, it is required that there could be policy interventions which could actually spark growth.
Okay, fair point. Exactly what should those policy initiatives be, especially on the liquidity front, where we just heard a bunch of them? That question after the break. Welcome back. We have been speaking with the members of the Citizens Monetary Policy Committee of CNBC-TV18, Soumyo Ghosh, Sajjid, Chinoy, Samiran Chakraborty, Sonal Varma, and Chairman of the committee, Pronab Sen. They have been outlining that growth definitely needs a helping hand. So what should the Reserve Bank do is the obvious next question. Samiran, let me start first with the liquidity steps because there's so much interest. A bunch of them have already been announced. Does that take care of it, or do you think the extreme Brahmastra of CRR cut also is needed?
So, Lata, the way we are looking at it is that if you assume that seasonally BOP is stronger in the Jan-March quarter, and whatever weakness in BOP we have seen in the month of January that reverses from February onwards, we move into some sort of a BOP surplus scenario, then maybe whatever has been announced is good enough to keep the durable liquidity in positive till March end. However, if that assumption is wrong, if global developments lead to more capital outflows and BOP turns deficit, then we might need more infusion of liquidity as we move forward. February 7th might be too early to decide on this matter. We might not have enough clarity on this. So maybe not too many liquidity announcements on February 7th itself. What will be very useful is if the RBI articulates the liquidity view more clearly, that they will want durable liquidity to stay in surplus as an independent objective, not just ensuring that the overnight rate is close to the repo rate, which has been the standard practice, which can be achieved through the daily VRRs also. Now comes the question of the CRR cut. Our sense is that the CRR has been reduced below 4% only in some sort of emergency situations in the past. This is definitely not an emergency situation for India. So we don't see the need for a CRR cut at this juncture. It might send wrong signals. However, there is possibly need to rethink the overall liquidity framework because the LCR thing is now very much prominent in the bank's minds. So with a large LCR holding, to what extent that 4% CRR is required or not, I think that's a more broader question, which at some point of time we will have to discuss and debate.
Oh, okay. I don't know if the RBI will venture into that on MPC Day, unless prodded on by some of our questions. But what's your sense, Sonal? Should growth be tackled only by rate alone, or does it need a mixture of rate and liquidity on February 7th itself?
Well, not necessarily Feb 7th itself, because RBI has already been proactive with durable liquidity measures. But clearly, liquidity easing is a precondition to ensure policy transmission takes place, because in the last 9 months or so, bank funding costs have gone up. So any rate cuts we deliver now, the full transmission is going to take time. So we need to basically do a lot more in terms of durable liquidity injection. I mean, for Feb 7th itself, we are not expecting any major liquidity announcement given the surprise we've already seen. But I think looking over the next 6 to 9 months, our own estimate is we need to create reserve money of over 4 trillion INR. And this essentially cannot come through one tool alone. So a mix of tools in terms of further VRRs, FX swap, as well as more OMO purchases. Our own estimate is over 2 trillion INR worth of OMO purchases will also be needed in order to create the durable liquidity. So it's going to be a mix of various tools going forward.
Okay, so that, and we may not know that on Feb 7th itself, obviously. But Soumyo, the Reserve Bank has been not just LCR, it has been sounding cautious even in terms of the credit deposit ratios. Do you think you will get a sense that the Reserve Bank will say, okay, credit growth has fallen enough, now it will change its lingo to spur credit growth? Are you expecting anything on those lines, the language?
Yeah, thank you, Lata. I think just taking this point forward, which others panelists said, I think liquidity continues to be an issue. But regarding the larger objective of this credit growth significantly outpacing deposit growth, I think that has significantly corrected in the banking system as of today. As of today, both the credit and the deposit growth are almost running parallelly together. So my sense is that the objective of the Reserve Bank of India calibrating their credit growth through the increase in the regulatory weights may have run its course, and possibly the fear of the deposits, actually deposits are now a little bit higher than the credit growth because of the decline in the credit growth in the last 1 or 2 months. So from that perspective, the central bank may be comfortable or may just indicate that the objective which we wanted to do with the credit growth moderation, that has been achieved. And basically we'll keep a strong vigil. But as of now, I think the objective of this credit growth narrowing down has been achieved for the time being. So that will be a part of the discourse of the central bank communication.
That will be very big, you know, if they also indicate that we are, as Samiran is asking, that liquidity, we will keep liquidity in surplus and we are satisfied with the credit deposit ratios. That is asking a lot from the central bank. Sajjid, are we really that confident of inflation? I mean, after all, the rupee is now at 87, 25, 30. Can we really be sure that the inflation problem dragon is bolted?
The core for a very long time. And I think even if you look at the last few months, the momentum has been soft. So one would argue that there is space for core inflation to absorb some imported inflation, if the rupee weakens. What we're also forgetting is that the rest of the world may suffer from an adverse supply shock because of a trade war, which pushes up prices. But in Asia, there's another disinflationary force, there's a countervailing force, because if the US and China get into a trade war, more and more of the Chinese excess capacity should come to Asian countries, including India, and that should be disinflationary. So I think on core inflation, despite a weaker rupee, I think there are no alarm bells. And with growth, with pricing power not really there in many sectors, much of these input cost inflation can be absorbed in the form of margins. The wild card here is food. And I think one has to bank on the fact that we've had a good Kharif harvest. Rabi sowing is going well. Food prices are rolling over. So I think over the next 3 to 6 months, there's some visibility here that inflation is going to be around 4.5%, which should give the RBI some comfort. One final point I'll make, you see, with fiscal policy consolidating, the onus on growth has shifted decisively to monetary policy. If we want rate cuts to be efficacious, it will not be efficacious in an environment in which banks are borrowing 1 trillion or 2 trillion from the RBI, because if they're doing that, behaviorally, they will not be cutting deposit rates. And they aren't cutting deposit rates, they aren't cutting lending rates. So the RBI will have to inject enough durable liquidity over the next 3 months just to ensure that banks have that comfort and start cutting deposit rates. By our estimates, they've injected almost 2 trillion of durable liquidity in the last few weeks. But despite that, in February, headline liquidity should be in a deficit of over 1 trillion.
Yeah.
And in March, over 2 trillion. So more work needs to be done. So I think liquidity is not adding for the sake of adding. You add as much as you need to get the monetary policy transmission of your rate cuts.
Okay. Well, actually, Dr. Sen, all your members are actually wanting the Reserve Bank to be much more considerate to growth. What is your sense? How should the Reserve Bank sound? Should they sound like we are here to help growth in every way, or should they be cautious?
No, I think they should continue to sound cautious. Not so much. I think the budget has raised no real issues as far as the MPC is concerned, but Mr. Donald Trump has.
Yes.
And until that plays out, if I were the MPC, I would be very, very cautious.
Oh, okay. So the chairman, I think, is going to vote differently. But gentlemen and Sonal, why don't we start the voting itself? First question is obvious. What will the MPC do to repo rate? Start with you, Chairman. Dr. Sen?
I think they should hold it as of now.
Oh, really? Okay. Samiran?
We are calling for a 25 basis point cut in the February policy.
Okay. Sonal?
25 basis point cut.
Soumyo?
25 basis point cut.
Sajjid?
25 basis point cut.
Okay. Chairman, sir, you've been overruled, and how? Why don't we come to the CRR? What should or will the MPC do to the cash reserve ratio? Dr. Sen?
I wouldn't fiddle with the CRR. I would operate with other instruments.
Wouldn't. Fine. Samiran?
No change in CRR.
Oh, okay. Now you'll agree with the chairman. Sonal?
No change.
No change. Soumyo?
No change for now.
For now. Okay, fine. Point taken. Sajjid?
No change.
Okay, so there's a
It's an emergency measure.
unanimity on this issue, at least for this policy. How many cuts in this calendar year, including the one in February, since some of you have? Dr. Sen, how many cuts?
Uncertain.
Oh, okay, you're not committing. Sonal, how many cuts, including the one in February that you have voted for?
100 basis point in total.
Okay, Samiran?
50 to 75 basis points.
All right, Soumyo?
75 basis points.
Okay, there's wide variety. Sajjid?
100 basis points, global conditions permitting.
Okay, fine. So actually, the committee is pretty dovish. The Citizens Monetary Policy Committee wants a cut 4:1 in the current policy. They don't want a CRR cut, but in the longer run, there are at least two people who want 4 cuts in 2025. Well, that's a fairly dovish MPC statement we have here. Wrap up on this special. Let's see what comes in the RBI-MPC.